Welcome back. Well, for the markets, it's steady as she goes, so no problems coming in. So let's talk about a couple of companies which have come out with their Q4 FY24 updates. Sadaf Sayeed, who is the CEO of Muthoot Microfin, now joins in to discuss the quarter gone by and what FY25 might be looking like in their limited capacity, considering that it is a silent period. Mr. Sayeed, thank you very much for taking the time out. Well, overall, it's been a good quarter because FY24 dispersals have been up over 30% year on year. Your assets under management have grown over 30% on a year-on-year basis as well. So the statistics are looking good. But if you had to just start by talking about the tenure of your book in Q4, has it risen as compared to a year ago?
Good afternoon, Ekta. Thank you for having me here. I think the numbers are generally looking very good. If you look at our asset under management, it has grown by 32% from 9,208 crores to 12,194 crores. And incrementally, our loan ticket size have grown only by around 10%. But the growth that is coming in is largely coming in by expansion of our distribution network. So in the last financial year, we have added around 336 branches, which takes our total branch network to around 1,508 branches. And our expansion has also reached to now 19 states. So we have added Telangana as the latest state, which is there. Our portfolio remains a two-year kind of a loan. Almost 97% of our book is two-year loan, but incrementally, we are disbursing three-year loan tenor also. So around 31,000 loans which we have disbursed last year are three-year tenor. And this is coming as a strategic kind of a shift from our side. We are borrowing also long-term. We have just recently raised ECB of $75 million, which is around 622 crores at a very fine rate. And that money is available for us from 3 years and 3 months. So that is allowing us to have a longer tenor loans, and it is allowing us to diversify our sources of fund away from banks. We are able to access new set of investors who are willing to give us money. So overall, the year was very good for us. The asset under management grew, the branch network grew, the client base has grown to now 33 lakhs 50,000, which was around 27 lakhs last financial year. And with more acquisition of customer, we are able to take the digitization also forward. So for the last whole financial year, we were at around 20% digital collection. The digital collection for the whole financial year FY24 has reached to 26%, which is a 30% jump. And incrementally, if you look at, we are collecting almost 30% of our collection month on month on digital format. So that is also helping us.
All right, perfect. Sadaf, always a pleasure speaking with you. The last year was good. Let's talk about the next year then. What's your outlook on dispersal and AUM growth for the next year? Does this 30% plus sort of growth continue? And to add to that, if you could give us a sense of the incremental cost of funds as well. You've locked in funds at an attractive rate from the ECB for a long period of time. So what are your NIMs likely to be around that 12.5% mark? And as we speak, digital, you said, is close to 24%, rather 26% of your business. You had a target of 30%. When does that happen?
Yeah, thanks, Mangalam. Likewise, it's always a pleasure speaking to you. I think on all the fronts, if you look at in terms of our NIMs are at around 12.7%, and our growth has been steady. In fact, when we had gone public, we were at around 34% CAGR growth for the last 3 years. It is now at around 39% CAGR if you look at the last 3 years. The current financial year growth is 32%. Of course, denominator has an impact, but we feel that around 30% growth we can easily continue to maintain. And the growth is coming, as I said, is from customer acquisition, distribution network, and use of technology. In terms of digital collection, so incrementally we are already at 30% collection month on month. So if you look at March collection, it was already 30% digital collection. But if you look at average for the whole year, it is around 26%, which was earlier 20%. So there's a 30% improvement on the digital collection. And I think in terms of our robustness of NIMs, it will continue to improve as our portfolio that we have originated post the liberalization of the regulation it is at a higher yield, and we are able to raise funds at a much cheaper rate. So our cost of funds have come down by 10 bips in the last financial year. And incrementally, the cost of fund is much lesser. It is around 10.4%. And we feel that we can easily maintain this 12.75%, 12.7% of NIM and continue to report a good amount of ROA and ROE that we have projected earlier.
Okay, all right. That's interesting because you've indicated that your cost of funds have come down by 10 basis points. You expect it to be maintained at these levels and your net interest margins as well. Just quickly then, in terms of the stress in the book, there was some chinks in the armor in the quarter gone by in your asset quality. Do you expect it to probably increase post-elections? What's your reading generally during an election year? And how are you viewing your asset quality right now?
So if you look at our asset quality, our collection efficiency has remained robust. It's at 98.4% on-time repayment. It is actually an improvement of 2.6% over the last financial year. At the same period, we were at 95.8%. So it has improved over the period of time in this financial year. And overall, I think if you look at NPA also, it's pretty stable. We don't anticipate any increase in NPAs. The portfolio quality will remain very good. In fact, the loans that we have originated post-COVID are performing really well. Our credit costs are going down as compared to the last financial year, where we had around 3% credit cost in FY23. It will come down significantly. It will be almost half of that in terms of credit costs.
All right, Sadaf, thank you so much for joining in. Although you're from a microfinance institution, you've come in at a good time for the market because as we speak, the Nifty Bank has hit